I'm about to give you guys what you came here for. Raise your hand if you'd like a hot stock tip, a good investing tip. All right. Let's take a look at something that I call the Silver Symposium indicator. If we take a look up here, this is the Silver Symposium 2 years ago in 2021. That circle at the bottom is the date of the event. This is also a chart of silver. You'll notice silver had been falling and it bottomed on the exact dates of the Silver Symposium and ran up to $27 per ounce from there. Now if we take a look at this next chart, this is the Silver Symposium last year in 2022. Oh, I don't have it. All right. The orange circle at the bottom was the Silver Symposium last year. The silver price had been falling. And from there, it ran up to $26 per ounce. Again, it bottomed on the Silver Symposium. And if we fast forward to now, this next chart, this was Thursday and Friday, Silver Symposium this year. Silver yet again bottomed. And if history repeats itself, then we got a nice little rally from up to $26, maybe $27 per ounce from here. So this is what I call the Silver Symposium indicator, that as soon as the event happens, that marks the bottom in the price of silver. So that's your one hot stock tip, good investing tip for this weekend. All right, so I have here's my promise for you guys for the next half an hour. 30 minutes from now, you will understand, number one, the history of money, the entire history of money. Number two, how the entire banking system works. Number three, understanding long-term and short-term economic cycles. Number four, how to forecast what comes next. How does that sound? Have a deal? Think we can do it? All right. All right, so let's imagine ourselves, everybody in this room, we are our own little isolated economy 2,000 years ago. We do all our trade with each other. We all have our own job, our role in our economy. This is 2,000 years ago, so most of human history was a gold standard, so we're using gold coins as our money, just like people did throughout history. So one of us is a roofer. One of us makes shoes. One of us has, cows make milk and cheese, and, you get the picture. We all have our own little role in the economy. So we trade with each other, and you might think, well, why are we defaulting to using gold for money? And the answer is because if you go back farther than that, most people assume we were bartering before that, and the reality is barter never existed. So imagine in our little economy, there's only a couple hundred of us. If I need to give, let's say I have apples, and I need some shoes from you. Let's say it would cost 20 apples to get a pair of shoes, or 100 apples to get a pair of shoes. But you don't want 100 apples. So now I have to go trade with other people, give them apples to get something that you want so that I can get shoes. Now imagine I have to do that 4, 5, or 6 times. What if I want to buy a house and it takes 1,000,000 apples? They're going to go bad before they can be used. And so this is the problem known as the coincidence of wants, and why trade always defaults to having a form of money. And that money is always the one thing that people will always accept because they know somebody else will accept it for payment. So throughout history, that's been things like rice, it's been things like cattle, but most of the time it's been gold or silver coins. And so in our little economy, we have gold coins. And so we have a set amount of money, right? Let's say we all have a couple gold coins. Doesn't matter how many transactions take place, how many cows I buy, how many roofs I sell, how many apples grow. There's the same amount of money no matter what. This means that when I want to spend money on something, I'm giving up spending money on something else. This also means that if my cousin comes to me and says, hey, I'm in a tight spot. Can I borrow some money from you? Let's say I want to do him a solid and I give him some money. Now I can't spend that money, right? So debt doesn't change the supply of money when you have a sound money standard. It means that I'm actually giving up some of my purchasing power which means that unless it's a family member, most of the time, I'm going to have to charge an interest rate that compensates me for that loss of purchasing power, number one, and for the risk that I don't get it back, and number three, for anything else that I could be making money on that money with during that time where I don't have that purchasing power. And so interest rates are set as a result of the supply and the demand of all the transactions that are taking place. Let's say we've all done a really good job of personal money management and we all have saved up a lot. Well, we're all potential lenders. So if somebody comes to me to borrow and I say 5%, he goes down the street and maybe they say 4%, he goes to somebody else, maybe you say 3%, and he borrows from you at 3%. So when there's a big savings pool, the borrower can get a better rate. The savings pool is large. That pushes the interest rates down. That incentivizes spending because I can't make a lot by saving. So it incentivizes spending, it incentivizes borrowing and risk-taking, and you get growth. Well, what happens after we've all then jumped on that bandwagon, we all start spending our money, taking on debt? Now the savings pool is low. I don't have any money, neither do you, neither do you, neither do you. And so now we're all trying to borrow, but nobody has money to lend except maybe one or two of us. Now they are the ones in control, and they can say, hey, all of you need to borrow. How about 10%? And maybe somebody is desperate enough to borrow at 10%. And if not, then I say maybe 9%. So then interest rates will go up when the savings pool is depleted, which incentivizes saving because now I'm saying, okay, well, if I can save up some more money, then I can be a lender and I can make some more money. I can't afford borrowing right now. And so it incentivizes sending, disincentivizes spending, and incentivizes lending. And so there's this natural built-in equilibrium. It moves back and forth. The interest rate will fluctuate, but it's set by the free market, by the supply and demand of money. The other thing is, let's say one of us is a gold miner. So you might think, well, that person can just print money, right? They can just pull money out of the ground. Well, not so fast, because there's a cost associated with pulling money out of the ground. Let's say that person who understands how to get gold out of the ground and refine it, turn it into a coin. Let's say it takes him 8 hours of just his own labor to produce an ounce of gold. And just in dollar terms so that we can comprehend this, let's just imagine gold as $2,000 an ounce. Well, what if he can make more than $2,000 for 8 hours of his labor doing something else? Well, then he's not going to pull more gold out of the ground. Now, the reality is, let's say, it's not just going to be him. He's going to have to hire people. He's going to have to buy equipment. He's going to have to pay for the energy to light up the fire, to melt the gold. So there's a lot of other costs that go into this. So if it costs him more than an ounce of gold to get an ounce of gold, is he going to mine? No. If it costs him less than an ounce of gold to get an ounce of gold, then he will. So when the savings pool is depleted and there's large demand for money, maybe we've all built up a ton of wealth. We have multiple houses, we have storehouses full of food, we have everything we need, and more than that, we have stuff that we want. There's more of a demand for money because there's been a deflation from all of the prices of everything going down as a result of the abundance going up. Well, then there's a demand for money. There's not as much money for all of the goods that are in our society. And so it's going to cost less than an ounce of gold to get an ounce of gold, and the supply of money will rise to compensate. So this is how money worked for most of human history. Now, there's a couple built-in problems with this model, and number one is globalization. So globalization is not a new phenomenon. You can find very old shipwrecks, thousands of years old, that have goods with writings on it from very different parts of the world. So the extent to which globalization has happened over the last 50 years or so is unprecedented, but there was global commerce happening for thousands of years. It's very difficult, though, to transact across large distances with commodity money because you have to ship the money as well as ship the goods. And the money is useful for buying all sorts of goods. And so as, let's say, a pirate, I can attack a ship full of grain and I can get grain and then I have grain. Or I can attack a ship that's full of gold and I have gold that I can use to get anything. And so it's very expensive, it's costly, it's risky to ship payments to get things from far away. And so that decreases the amount of global commerce that can happen. So that is a headwind in the face of a pure gold standard. The second headwind is the deflation that occurs. And so we know what happens when they print a ton of money and make money way more abundant. What happens to prices? They go up. So what happens if the opposite happens to the money? Let's say the money just gets destroyed. Tomorrow we have 10% of the money that we do today. What happens to prices? They would collapse. And so if the money stays the same, but all the stuff that we have grows abundantly, that's the same thing. Prices go down. Because today it might cost 10 years worth of my labor to be able to buy a house. But if we build way more houses, then they're more abundant, maybe it only takes 5 years of my labor to buy a house because there's way more houses, way more supply compared to the demand. Maybe it only takes a year of my labor to buy a house. And so if you have the same amount of money throughout history, but you still have economic growth from building and creating more stuff, then prices go down over time. That's good for the most part until you get to the point where you're not carrying around your gold in your pocket anymore because it's worth way too much. It used to, thousands of years ago, be good to, buy a sandwich or buy lunch or buy something, your weekly groceries. But now it's like a down payment on a house or it's a horse. And so I'm not carrying that around in my pocket anymore. I need to put that somewhere safe. So the deflation over time makes the money so valuable that it drives it out of circulation for transactions into storage. So you get the rise of bankers. The original ones were goldsmiths. And they were just the storage place for metals. So I would put my metal in storage with a banker and deposit with him, and he would give me a little piece of paper that says, I have an ounce of gold in storage, I can come back and get it any time. Well, it's no longer necessary now to actually go get it from storage, right? Because if I can use this paper to go get my gold, somebody else can use this paper to go get my gold. So I can just give them my paper for payment. And so that's how you got the rise of paper money backed by gold. Now, I want to be very clear about this transition that nothing monetarily speaking has changed. Monetary policy is the same. It's the same amount of money in circulation. The paper acts as a proxy for the gold. So we still have the deflation. We still have the sound money. We still have, if I borrow from somebody, that means they can't spend. The money supply stays the same unless new gold is mined out of the ground. So nothing has changed. We do get the added benefit, though, of large distance transactions. And so instead of me having to ship gold, I can just trade the ownership of that gold with somebody somewhere else. Now, there's obviously going to be still some friction there because somebody else in another country may not trust that they can get that gold because it's so far away. But you still have the ability to transfer ownership of gold rather than the gold itself, which increases transactions across long distances. It also solves the problem of deflation because instead of having to make a coin that is 1/10 an ounce of gold, I can just write on a piece of paper, it can say any amount of gold. And if I want to go get a full ounce, I just need more paper. So it solves the problem of deflation with infinite divisibility. That's what paper backed by gold solved. But we all know that this didn't last because of the biggest problem with this solution, which was the temptation from the bankers to offer a second service, which was lending. They start off as savings institutions and they introduce lending. So just to recap, when I borrow money from you before, you can't spend that money anymore. Which means that if everybody's trying to borrow money from you because you're the only one with money, you get to charge a really high interest rate. So interest rates, being the price of money, are just communicating information to the economy about the abundance or the scarcity of the money relative to everything else. It's information about how valuable that money is and whether we should be trying to get more of it or have less of it. When the banker starts to offer loans, the banker doesn't have to give up his own money because he realizes nobody's turning in their paper for gold anymore. So I'm going to put a sign on the window that says, you can come get a loan from me. I know Aunt Sally and Uncle John and everybody is offering loans at 5%. That's the market rate, the true rate of interest. But I don't have to give up any of my own purchasing power here. And so I'm going to offer loans at 3%. Who gets all the lending business then? Me. Everybody who wants to borrow money is going to come to me instead of going to Aunt Sally. And so what they do is they come in and they ask to borrow money. I give it to them at 3%. I give them a piece of paper. It says the same exact thing as all the other pieces of paper, that they can come get gold at any time. That's what makes it money. Once that happens, the moment that happens, monetary policy has changed. We get inflation for the first time because the money supply has grown. And this is the first lesson of how the banking system works, is that money is lent into existence. That's how the money supply grows. Money is lent into existence. Because the moment they walk in the door and I make the loan, I printed up that piece of paper and I hand it to them, they owe me money back, a loan was created, and also additional money was created. And so money is lent into existence. Now what that person does, the first person who borrows that money, is they go out and buy something with it. Otherwise, why are they borrowing money? So they're going to go out and buy something with that money. Have prices changed yet? Prices have not changed yet. This was the first loan that was made. So they go make a purchase at the original prices, which means that they, as the recipient of the newly created money, get the advantage of the old prices with the new money. But when I spend money, let's say I borrow that money and I go and I spend it on shoes. The shoemaker now has income that he wouldn't have had otherwise. Because without me getting that cheap loan, I wouldn't have been able to afford those shoes. But now I can, so I go buy those shoes. So he has income he wouldn't have otherwise, which means that now he gets to go do something with that money. And he goes and spends money on something he wouldn't have bought otherwise. And so you get the money circulating throughout the economy, buying things that wouldn't have been bought had that new money not been injected through loans, bidding up the prices of goods and services. What's the problem with this? Well, can this continue forever? It depends on what the banker does, because eventually that first loan has to get repaid. It's debt. That whole thing, the boom, was built on debt. The increase of the money supply based on artificially low interest rates. So because it was loaned into existence, when that debt gets paid off, that money ceases to exist. So that first person who borrowed money from me, they go spend that money at the old prices. Everybody starts borrowing money, spending money, prices get bid up. Then some people have to start paying off the debt. So they have to take money out of circulation, take income, and instead of going and spending it like normal, they have to turn around and pay back that debt. So the money supply goes up, then it starts to go down. Now, I as the banker, and I need to pause here because I know that for most of you, you're probably thinking of what's happening today with the Federal Reserve and central banking, and we're not there yet. So stay in our imaginary old economy here, mentally. At this point, the banker has two choices. He can look out and he can see, okay, my gravy train just came to an end because nobody can afford to keep spending now, so they're paying off the debt instead of continuing to borrow new debt. So I have a choice. I can lower interest rates again because it's no skin off my back, it's not my money. So I can lower rates to 2% and restart this whole thing over again. And now instead of paying off the debt, people just get new debt to pay off the old debt and then spend even more. And the whole cycle resumes and the boom keeps on going. And then eventually it runs out, people lose the extent of their purchasing power, have to start paying off the debt, and then my gravy train runs out again. So I have another choice. I can lower rates again to 1%, restart the whole thing over again. Now, a smart banker will look at that situation and realize if I continue down this path, eventually people will realize there's way more money in circulation than there is gold in the vault. Because people are buying stuff, they're spending money, they're looking around and they're thinking, well, we know how much gold we initially put in storage, so how does everybody have so much money? How are prices going up so high? Oh, it's the value of the money that's declining because it's been loaned into existence. And at that point, a run on the bank happens, or hyperinflation takes off and then a run on the bank happens. The banker gets run out of the city. He's never going to run a bank again, or stoned. And like him stoned, not weed. Like he's just killed. And so you have him run out of town. The bank collapses, and everybody gets smart and doesn't participate in something like that again. But the banker can usually, unless he's really not smart, the banker can usually see that coming, and they realize, I've got to get ahead of this, and I've got to make sure that things go back to normal. So I'm going to raise interest rates, because that way nobody can afford to borrow then if I raise interest rates, which means that all the existing debt continues to get paid off, and then as that debt gets paid off, money supply decreases, prices come back down to normal. Now, that is the boom-bust cycle, and so it's important to recognize that because it's not a business cycle. It's a debt cycle. It's really a boom-bust cycle, which is things going up in price and then down in price as a result of the money supply increasing and decreasing based on what the interest rate does, somebody controlling the rate of interest. The reason why that's significant is because we today hear all sorts of blame for all these other reasons, like corporate profits and deglobalization, and there are a lot of other factors, but the main thing happening is this exact same cycle that we know has happened historically. We can study it, we can see what its effects are, and it's happening again today. All we have to do is go back a couple of years. Business activity starts to slow down. So what do? We don't want the gravy train to come to an end, so we're going to lower interest rates. The money supply is going to expand. Everybody's going to take this money and they're going to spend. It's going to bid up prices of asset prices and goods and services. Everything's going to be great, right? Until prices continue to go up higher and higher and higher. Then the central bank gets scared and they say, oh, we're about to have a run on the bank, or we're about to see a collapse in the value of the currency, and so they need to get ahead of this. So we're going to jack interest rates way up. Now people can't afford the new debt. Debt automatically gets paid off, so the debt supply, the money supply starts to decrease, and we start to see the deleveraging, and the bust starts. And so we're seeing the exact same thing happen today that we have seen happen many, many other times. The other thing that's important to understand about the boom-bust cycle is that we get an up and a down, and an up and a down. And we've probably all seen videos and charts of, hey, this is just the business cycle, right? But ultimately, we're always going to have more and more wealth in the future. You just have to ride out the bad times. You have to, you have to just, make it through, and eventually things will come out the other side. What they want you to believe is that the boom-bust cycle will result in the same amount of wealth with just a little bit more volatility along the way. This is a fundamental misunderstanding about how compounding interest works. So start off with 100, and let's say you drop by 20%. What number are you at? You're at 80. Now go back up by 20%. Where are you at? 96, because 20% of 80 is 16, not 20. And so losses are more powerful than gains. And so when you drop by 20%, you no longer need a 20% return to just break even. You need a larger return to just break even. And the larger the loss is, the more of a gain you need just to break even. If you have a 50% loss, now you need a 100% gain to get back to break even. And the other thing is, it doesn't matter what order this happens in, right? So start at 100 and go up by 50%. Where are you at? 150. Now go down by 50%. Where are you at? 75. And so it doesn't matter what order this happens in. When you have large losses and large gains, you end up in a worse spot than if you eliminate that volatility and those large drawdowns, even with a smaller gain. And so when we see this boom-bust cycle, this is a net destructive force on creating wealth. When you get to the end of the bust, it's not that you're just back to where you were before. You're in a worse place than you were before. Because during the time when all that money was going out, just imagine the last couple of years, what were people spending this money on? Well, at first it was toilet paper, and then, Rolexes, and man, I went during, I think it was 2020, to a mall, and I saw the line for the Louis Vuitton store was 2 hours long. Everybody lined up to spend their stimulus checks at Louis Vuitton. So we have a malinvestment, misallocation of resources that happens during this. That is where the damage takes place. That is where during the boom is where people make economic decisions based on false information. People felt rich, they had more money, interest rates were low, so it felt like the savings pool was abundant. But that was artificial, that was imposed on the system, it wasn't true. And so people made bad economic decisions as a result of the false information, and the bust is just the realization of that. The damage has already occurred. And so that's one of the major problems that most people don't recognize with the boom-bust cycle, that we don't get to the same place with more volatility. We actually end up with less wealth than we would have otherwise. So now we're looking at today and we think, okay, we're at this place where it looks like a recession, an official recession is right around the corner. We have a huge pileup of debt. We have savings rates at all-time lows. We have interest rates at multi-decade highs, in many cases even higher than that. And we have a government that cannot get its spending under control. We have a stock market that is at valuations higher than it's been in like 150 years. We're like looking at this and it feels like we're on the precipice of falling off this cliff, economically speaking. But we need to take a little bit of a zoomed out view of this. When in doubt, zoom out. If you want to not make decisions out of fear of the short-term moment, let's just zoom out and take a look. So from 1940 to 1980, interest rates and inflation were both rising. It was about a 40-year cycle. 1940 was World War II. We had massive deficit spending. The debt to GDP ratio in 1945, I think, hit 120%. That's a line that people say you can't really come back from, but we did, dropped off from there. And for the next 40 years, interest rates were volatile, but on average they rose. Inflation rose as well. Obviously, we had the whole thing, the little Nixon scandal, and leaving the gold standard. So that had an impact. So we had inflation, we had rising interest rates, this 40-year cycle. Then things kind of peaked, and from 1980, for the next 40 years, interest rates fell. So did inflation for the next 40 years. This long-term 40-year cycle. So let's just look back over the last 20 years. Every time we've gotten into an economic problem, what has the Federal Reserve done? They've lowered interest rates, just like bankers always try to do to soften the blow, get people to spend again, restart that gravy train. They're probably not going to be able to do that this time. And the reason why is because when you look at the dot-com bubble burst, they lowered interest rates. That fueled the housing bubble. Then when that exploded, they lowered interest rates and bailed out the banks. And then from there, that fueled an even bigger bubble that took a little bit longer to form, that started to pop in 2019. Raise your hand if you remember the September repo crisis. When they started not QE, that was in 2019. And so things started to fall apart then. And it was a breath of fresh air for central banks that something like COVID happened so that they could print money to cover up everything that was already starting to explode. And not only did they lower interest rates like they did to stop the dot-com bubble bursting damage, not only did they bail out the banks, they this time had to bail out the entire economy, print way more money, bail out everybody. This time, though, there's always somebody who absorbs the risk, absorbs the damage. And this last time, that damage got absorbed by the United States government. So now we are back up, the US government, 120% debt to GDP. No World War II, no World War III. So just spending for spending. Nothing that we can just shut off. In World War II, when the war ended, the spending stopped, and so debt to GDP collapsed. That there's no war to just stop this time. I mean, there is, but not like World War II. Now we have the deficit exploding. The deficit is the difference between taxes and spending. The deficit is growing again, even though there's no official recession. We have interest rates exploding. Now, part of that is the Federal Reserve, but part of that is the market realizing things are bad. Can't do 2%, 3%, 4% anymore. We need higher rates. And so the government is now spending more and more and more money on debt. Last quarter, $969 billion per year just on the interest on the national debt. Now, you can go through the math. In a year and a half, that number, assuming everything stays the same from here and doesn't get worse, that number will be $1.2 trillion in a year and a half. That's just the interest. So the federal government, the United States government, by all measures, is facing a sovereign debt crisis. They cannot afford their debt, and that itself is causing their debt to grow. And because the debt is growing, it's making their debt more unaffordable, pushing interest rates higher and higher as they have to borrow more to pay the higher debt. It's a snake eating itself by the tail. And so we have a pickle with the US government is going to be the next one to need the bailout. When you look at something like large corporations, they made a better decision than most. A lot of people are not aware of this, but most large corporations refinanced pretty much all their debt during 2020 and 2021. They have extremely low interest payments, and now what they're doing with all that cash, they're putting it in treasuries, T-bills. So they've locked in, 2%, 3% on their debt, and they're making 4 or 5%. So their cash flow situation, their balance sheets, everything is improving right now because interest rates for the government are going up. There's a large wealth transfer away from the government during this last bailout. So where are we headed from here then? We know that there was 40 years from 1940 to 1980 where interest rates and inflation were going up, and then the next 40 years were followed by inflation and interest rates moving down. You can't really go below zero, though, and they hit zero in 2020, and most people thought they would stay there. But it looks like we've started back up that next cycle with interest rates and inflation moving higher. You might think, well, that doesn't make any sense. How can you have inflation and interest rates moving higher? Interest rates going up is supposed to stop the inflation moving higher. Well, that would be the case if we don't get a bailout of the federal government next. So let's say that the Federal Reserve gets religion and starts doing things the right way. We've seen Powell actually recently come out and make comments like this. So a reporter asked him a couple months ago, said, hey, the fiscal situation for the US government is very bad. Is there any chance that you guys might, help the federal government, refinance the debt? He said, under no circumstances. So that could mean one of two things. He didn't even elaborate after that. One of two things. Well, number one, he could be referring to the letter of the law. Debt monetization, outright purchasing of federal government debt, illegal. Federal Reserve cannot do that. So he might have been referring to that and saying, no, that's not our job. We don't do that. We can't do that. Obviously, they've done QE in the past, though, which is buying up government debt on the open market, which has the same effect. It's just indirect. And so he may have just been referring to that. But when you start reading between the lines of some of the other things the Federal Reserve has been saying and doing, it looks like they've realized they've lit a fire that they may not be able to put out. That monetary policy is at odds with fiscal policy right now. The government is spending way too much, and the central bank right now is trying to get a handle on it so the dollar doesn't collapse. And it's making the government's job harder, their spending job harder, which is a good thing as long as you continue to make that happen. Eventually, though, we're going to get to a point where the federal government will not be able to afford its bills. You just follow this line, and I don't know the time frame on that, but eventually you get to a point where they literally try to borrow and there's nobody left to borrow from. There's no bid. Nobody's buying treasuries anymore. The federal government tries to offer 10%, and there's nobody there to lend to them. Now, at that moment, you have a default. So at that moment, you may have the Fed change its mind and say, we're going to print that money so that the government doesn't default and we don't, completely collapse overnight. In my opinion, if they don't do that, then Congress will act faster than it's acted in probably forever and rewrite the Federal Reserve Act. Because at the end of the day, the Federal Reserve exists only because of and does only what Congress allows it to do. They exist because of the Federal Reserve Act, and their mandates are given to them through the Federal Reserve Act. And so Congress will get together and say, we have a new job for you. Your job is to fund the federal government. And then there will be no more independence. They will be there just to print the money to fund the government's expenses. So either way, that's where we're headed. Price is down first. We're headed into a bust. Eventually gets to the point where the government can't afford its expenses. It'll need to be bailed out. It'll get bailed out through the money printer one way or another. And because of that, the additional spending and the increased spending from the government now taking control of the money printer will cause that long-term 10, 20 plus years of inflation. As a result, all of us will have to have even higher interest rates because inflation is embedded. The big boys didn't know that 2 years ago. A lot of us did. The big boys, the big money, didn't think inflation was going to last. So they were lending at 2%. They were lending at 3%. Now they're in trouble, and they're not making that mistake again. They are only going to lend at rates that they feel are compensating them for that risk of loss of purchasing power in the future. And if the government takes control of the printing press, interest rates are going to have to skyrocket for everybody. Nobody's going to be willing to lend because they know that inflation is embedded. So we're headed into a period, for much longer period, a long-term cycle of higher interest rates and higher inflation. We're not there yet. Things are going down first. But once they get bad enough, that's where things will turn. Now, this last portion I'd like to discuss is how to thrive in this world. Because things have really rapidly started to change over the last 10 years or so. It used to be just common knowledge, financially speaking, go to school, get good grades, get a degree, get a good job, you'll be able to retire with a gold watch in 40 years. That's not the case anymore. That's not true anymore. We live in a very rapidly changing world, and when you see declines of empires like this, things can change even more rapidly, especially financially speaking. So how does one learn how to thrive in a world where you don't have short-term history to rely on as a marker for what the future holds? The stuff that used to work for the last 40 years won't work for the next 40 years. We're not in a bull market anymore. Interest rates hit zero. They can only go up from there. They're not going to go lower than that. Bonds reached their peak. And so there are many things like that where we are experiencing a different future than our recent past. So number one, we have to even more zoom out. Are there things that have been true throughout all of human history instead of just the last couple of decades? And one of those is just basic personal money management. You have to de-risk yourself. If you are heavy in debt, if you are not protected against your downsides, even just the basic stuff, like what if there are disruptions in the grid, in utilities? Like, will I be okay? You have to protect your downside first because it doesn't matter what your 401k says. If there's some sort of a natural disaster and they're locked down and you're stuck in your home for 2 weeks and there's no running water and you die of thirst, right? 401k doesn't matter at that point. So you have to be able to cover your risks, your major downsides first to be able to fully capitalize on potential upsides. So risk management is key, and that's always been true, always will be. Personal money management is a big part of that, being able to get out of debt, making sure that you are spending less than you are making, and using the difference to invest high-quality assets. If everybody in this world, let's just say this country, if everybody in America was wealthy, very wealthy, would we have any nationwide financial problems? Okay, I heard a lot of yeses. Who would need transfer payments for Medicare, Medicaid, Social Security if they were personally wealthy? This is just a thought experiment. I'm not saying that it's going to happen. If everybody was wealthy, we wouldn't be in the financial position we are as a nation today. The transfer payments wouldn't be happening. The big buildup of debt wouldn't happen. Individuals wouldn't be loaded up with record high debt. Corporations wouldn't have this record high debt. We wouldn't have the most over-leveraged economy in history. We wouldn't have people that most Americans, if an expense of $1,000, 60% of Americans, if an emergency expense of $1,000 came up, they wouldn't be able to pay it. Negative net worth, no emergency fund, cannot survive a missed paycheck. That's most Americans. Now, I talked about this a little bit last night, but if you individually make it your duty and your mission to become as wealthy as possible, do you think that that will put you in a better position to take care of those that you are responsible for? Absolutely. And so, number one, the wealthier we as an individual become and make it our duty to become, the better off our world is. But the more individuals that do that, the better the world is. And so I have a challenge, and this is just a thought experiment, because one of the most common questions that I run into is, what should I be investing in? Almost everybody wants to know, what should I be investing in? And most of the time, when I ask one further question first, which is, well, how large is your portfolio? How much money do you have to invest? It's very, very small. And the reality is, it doesn't matter what you invest in if you only have $10,000 to invest. You could have a 30% return for years, and that wouldn't you'd have to maintain that for decades for that to produce real wealth. So the number one step is income. You have to have something significant to invest first before the question of what to invest in matters. And so a thought experiment would be, that I would challenge everybody to think about, is what would it take to double my income? And I know that might sound crazy, but just a thought experiment. Because looking at something like if you look at, what would it take to increase my income by 10%, even 20%? The default is promotion, get a raise, get a new job doing the same thing at a different company, maybe do a side hustle. And that certainly will be helpful for a lot of people. But if you want to be able to build something that can take care of everybody around you when the shit starts going down, you're going to need more than a 10% raise, especially if inflation is 6 or 7%. And so thinking through the lens of, okay, well, what would it take, just hypothetically speaking, to double or even triple my income? Could I do double what I'm doing right now? And if that would result in twice the income, then that might be an answer. But most of the time, that's not going to work. Maybe you are already working 60, 70, 80 hours a week. So my challenge to you would be, before trying to figure out what the next best investment is, and even though we looked at the Silver Symposium indicator at the beginning, would be, what can I do to drastically increase my income? And then you'll be able to invest it, and the investments that you make, the assets you purchase, will be meaningful. And for many people, this is going to be starting a business, this is going to be starting a side hustle, this is going to be doing something drastically different. And so I understand that, it's just a thought experiment, but it's my challenge, because I do believe that we have a responsibility, understanding what's coming, to be as prepared as possible. And the more of us that are prepared, the better off we'll be on the other side, and we'll be the ones with the resources to help rebuild things from the ground up. So that's all for tonight. I really appreciate you guys, and thank you so much, and we'll keep going.